Hello and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am Pushpendra Mehta, and my guests for today are Jack Large, editor of CTMfile, and Craig Jeffrey, managing partner and strategic treasurer. Welcome to the Open Treasury podcast focused on ESG investing, Jack and Craig. Today's podcast is centered around ESG investing. And for the benefit of our CTMfile audience, this discussion is based on the recently published article on CTMfile.com titled ESG Investing Gaining Momentum. Emphasis is heavily on the E element. Before we dig deep into the article, Craig and Jack, I would like you to please explain your perspective about the key differences between the three elements of ESG, namely environmental, social, and governance. Craig, if you would like to go first.
Sure. I refer to the list that show what goes in these categories because sometimes, my structure may look a little different. When we think about environmental, we think about carbon pollution primarily. I think historically it was more centered on deforestation, though that is still part of it. It's not nearly as much focus as carbon. I know it covers water usage and other areas too, but those are the primary ones for environmental. On the social side, this is about people and their information. So things like gender diversity, data security, protecting data. And you see that with all these different schemes for protection across the globe, regionally, by nation, even by subsection of nations. Even things like fair labor practices across the board or across your supply chain. When income goes up, employee safety and better environments tend to follow. There's quite a vast difference in terms of what would be considered acceptable in one country to another. And so some of the social part really covers people and their information across the supply chain. Governance touches on things like corruption, lobbying, but also diversity by various select lenses of board members and leadership at the top of the house to other areas as well. So environment, people and their info is the social side, and governance, more focused on diversification and lack of corruption or avoiding corruption.
For me, the key piece about ESG is how complete it is. Each of the categories which Craig has gone through are really complete there, and there's been a massive amount of work to define each of the areas way down in detail. It's having a big impact, not just on investment, but on the way people manage things, the way the governments manage companies. They now don't just look at diversity, they also look at their social impact, their environmental impact. It's a very important piece of work. I congratulate all the people who've worked on it.
Let's explore the ESG investing article further by first summarizing some of the key findings of the Capital Group's ESG Global Study 2022 published in the article. The ESG Global Study 2022 highlights that more global investors this year say ESG is central to their investment approach and is driven by client expectations and reputational concerns. According to the study, Europe continues to lead the world in ESG adoption, with more European investors citing ESG as central to their investment approach than those in Asia Pacific and North America. The study also highlights interesting yet different ESG adoption momentum drivers for Europe, North America, and Asia Pacific investors. European investors are more motivated by the desire to make an impact. North American investors attach far more weight to meeting client needs, and Asia Pacific investors or respondents are particularly motivated by investment returns. Global investors are concerned about climate change, which is why it is a key dimension of ESG considerations for investors and at the forefront of their minds. The continued dominance of the environmental element of ESG explains the more focused allocation to this component of ESG, which has slightly increased its share from the previous year. While climate change is a top priority item for ESG investors, 4 in 10 investors think social issues are being overlooked because of the focus on climate change. This confirms why global allocation to the social segment of ESG has remained unchanged, while the focus on the governance element has marginally decreased this year. It is good to know that the ESG investment or investing is gaining momentum. After reviewing the ESG Global Study 2022 from Capital Group, what I found most interesting as well as somewhat concerning is that the environmental or the E element is more of a priority than the social and governance component of ESG investing. As you know, there is increasing interdependence between environmental, social, and governance issues. However, not all ESG components are being given equal weight when it comes to investing. What are your thoughts about the environmental or the E element remaining the top priority in ESG investing? Do you think this is because Europe continues to lead the world in ESG adoption and has shown more focus on climate initiatives, while in the US, diversity and inclusion requirements have received more attention than elsewhere?
I think it's very much dependent on the social issues and in each of the different areas. The one thing that is common to all of it is that only when you can measure things is it really being able to be managed. Unless you can measure it, you can't manage it. Well, in the social area, we're starting to see new technologies in the supply chain monitoring and understanding, like Prima Dollar have introduced a new technology to actually monitor the success with workers, but getting the opinion of the workers, not the managers, the workers. And it's that sort of new technology which is going to change the face of where we do our ESG. It will always vary by local area, but the technology also needs to change as well.
I think there's a couple things here that I would point out. I don't necessarily agree that the movement towards ESG is accelerating. I think it's moving steadily in that direction. I think it goes a little faster from one year to the next, or a little slower. It's moving in that direction for sure, but I don't see it like continuing to grow at an escalating rate. I think there's some natural pullback, which I think is, for those that really love ESG, that's a good sign that it's moving in that direction, that it's learning and morphing there. I think the second part is, as Jack said, some of the technology pieces, like he brought up with Prima Dollar, really bring down the cost and effort of following these. And same thing on the environmental side. On our Treasury Update podcast, had an interview about moonshot technologies and some of the work that's required to reach some of the goals. The tech isn't there yet. And so efforts being put into items that will leapfrog, allow you to jump significantly ahead, are going to be necessary to meet some of these goals. So I think there's a long trend in a direction, and then there's need for tech like Earth-based tech as well as like moonshot tech to help us get there. And this idea of the environmental focus, and if we roll energy into that as a huge component, because energy is so essential for our business's success. We can't do these things without well-running, efficient economies and good growth. And handling that is going to be continues to be extremely important. So as we have these trials and challenges with energy, I think that should allow us to focus more on that, so that the environmental side. The environmental side is top in every area of the world as they weigh against the other elements of social and governance.
Moving forward, according to the Global Study 2022, another factor driving ESG momentum is reduced concern about greenwashing, particularly among European and Asia-Pacific investors. And while prevalence of greenwashing has dropped across all regions, a higher percentage flag concerns about greenwashing in North America than in Europe and Asia-Pacific. This may explain why North American investors have the lowest percentage of ESG users. Craig, if I may direct this question to you first, do you think increased scrutiny of greenwashing by the US Securities and Exchange Commission and the Federal Trade Commission will prevent more North American corporations from overstating the environment-friendly credentials of their products to investors and result in increased ESG investing in North America?
Well, I think any type of regulation and broader governance brings that about over time, particularly with new areas. So some items become new, such as, I think we should still classify this as a relatively new area. It's not established for decades and decades. So it's a bit uncharted. More formality of rules tends to provide some consistency. There usually becomes a series of fines for when you step outside that. Then it becomes a more stable process. I mean, we've seen that you see that across the board. We've seen that with organic food, right? It was like, okay, organic was this. There was no definitions. Then they became more refined. And then there became, here are some of the standards you used. And then it became more mainstream in terms of what defined organic. And I think that's really how this takes place. I mean, it's always hard to move into that. And sometimes there's a overreach, or an underreach, on regulations, on claims. But this idea of, greenwashing or having a veneer, and then underneath it, it's not real. That part has to shift.
The exposure of what's going on in greenwashing needs to be done at the government level, as you were describing, and as the US are moving forward on. But also it needs to be done on an end user level. And increasingly there are more and more movements of different people, different groups to expose this, because we've still got the crazy thing of the oil companies saying that they are now green compliant and moving to net zero by 2050, yet at the same time they are increasing their oil exploration. Doesn't make a lot of sense.
The next topic is about ESG integration through active funds. When investing in ESG, a strong inclination toward active strategies is again noticeable this year. As per the survey report, nearly 2/3 of global investors prefer active funds to integrate ESG. Active funds are most popular among North American and European investors. Jack, why do you think global investors prefer active funds over passive funds and hybrid instruments such as active exchange-traded funds when investing in ESG?
I'm not sure they do. Active funds don't have a very good record. The passive funds have just as good a record and with far less risk. Having said that, active funds are, I find, being used more by very specific investors who really focus on a particular area. And that is going to increase.
I want to start off by saying, I don't know. I don't know how much they're moving and why that is. But here is why I would suspect that. When you look at more established indices or markets, there's a certain level of market efficiency that makes index funds more efficient than actively managed funds. To a large extent, certainly over time, because there's a certain level of efficiency and the extra cost of active management tends to eat that up. And so very few funds stay in leadership position for 3 years in a row, 5 years in a row, 7 years in a row. But to the point that this is a fairly new area, it would seem to make sense that there would be areas where there's a difference in knowledge, awareness, depth, that some managers could do a better job than the market as a whole, because there's so much that's changing. Because there's so much that's changing, the market isn't quite as efficient here. That would be an assumption. I have no idea if that's actually accurate, but since it's newer, that would seem logical and likely. But again, don't invest based on my advice.
Can I just add to what Craig said? You're absolutely right, Craig, that because it's such a new field, the active people, the active investors, the active groups are going to be more attractive. The issue for me is, when does it stabilize and we get some norms of behavior? At the moment, it all seems very gung-ho and always innovating.
My fifth question is about ESG asset classes investment distribution. Craig, if I may direct this question to you, do you think the ESG asset classes investment distribution in the report indicates a shift towards alternative investments to primarily protect against inflation that has exacerbated because of the pandemic, supply chain disruptions, and the Russia-Ukraine conflict? And do you see any shift in this distribution in 2023?
Well, let me say this. I mean, the focus on commodities due to supply chain issues, rising inflation seems logical and natural. And so that would be, even if your social demand or your environmental demand is to invest a certain percentage, you still need a certain return. These are logical and reasonable areas to focus on that. When we think about energy, whether it's focusing on renewables or even other traditional areas, we have to keep in mind what the demand is, and what that will be for a long time, even if we look at goals for out as far as 2050. And so there's this longer term view that we always have to keep in mind, that these changes take time, and what's going to be, what's a huge focus. If things are great, the focus can be on different categories. If the concern is about health, safety, food, or freezing, those will demand all the resources. Everything else will be cut out to provide for that safety. Things like comfort, it's not as cool as I'd like it to be, or I can't buy certain types of clothes. Those will, or eat out as much. Those will drop dramatically in the middle class and upper middle class regions of the world. So this focus a bit more on commodities, like a tripling in that period of time, seems to flow from that logical sense. That would be my guess as to why that is.
Jack, do you have any final thoughts on this article or anything of particular interest in the Capital Group's ESG global study that you would like to share with our audience?
Yes, the thing about ESG is that it's all three categories that matter in this monitoring, and investors are getting much more canny, as far as I can see from the odd phone call I have from investors, that they are looking at all three aspects now rather than just the one. That's the first point. And the second one is that investors are getting much more wary about accepting messages. They need to dig much more into the detail of each of the messages when they make an investment.
Great. I would say, Push, that there's a real sustained focus on these categories, ESG, over time. It's not always accelerating rapidly. It's not compounding, but it's moving in that direction steadily, significantly. And I think there's a couple things. One is there's a recognition this takes time to move properly. And I said that before. The other piece there too, on a balance side, is the majority. If you look at any region of the world, the majority don't have the conviction that ESG investing is central to their investment approach, though that is more than the non-majority that aren't, or that are on the sidelines. There are a number that are on the sidelines. There's more where it's a conviction, but these aren't the majority. So there's this whole middle ground, and that's part of the where are things moving, where they're going. And then there's this, all of these items, are being paid more attention by more investors, more leadership of companies. And it's a long journey. So I think it's just, how do we take a rational approach to what are others doing? Where are things heading? How can we best respond and be good stewards of, each of these categories?
Excellent. Thank you so much, Jack and Craig, for your incisive and informative insights. These, I hope, will be of tremendous benefit to our CTMfile audience, whom I would like to thank in abundance as well for joining us on this edition of Open Treasury. Please subscribe and look in the show notes for the article link. Thank you. This podcast is provided for information purposes only, and statements made by CTMfile or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.